I think going forward, there's still going to be tremendous winners among AI-related theses, but it's going to look a lot different because I think the government's going to have to do something and stimulate different parts of the market to accomplish their one goal of re-election. And that's going to require lifting Main Street out of recession if they want to win.
This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. All right, everybody, welcome back to another Roundup edition of Forward Guidance, and we got our pre-Thanksgiving holiday long weekend episode. So we're recording here on a Wednesday, and this will be out in pretty quick order ahead of the long weekend. So welcome, guys. What's going on?
Happy Thanksgiving. My friend sent a good meme this on like Sunday of this week. Is like Thanksgiving, everybody going into the office for Thanksgiving week, and it was a picture of like a Madden play call that was just QB kneel, and everyone was just like trying to just glide through the week doing as little as possible.
It reminds me of the super bad meme, you know, where he's like, what are you doing? 2 weeks of school left. I'm just drilling holes. And he's just like drilling holes. 2 weeks left, just drilling holes.
That's so good.
I don't know about you guys, but I was jammed today. You guys are just mailing it in.
Yeah.
Nailed it.
At least somebody's working. You know, you're going to be the last one to get replaced by the AI overlord. So good on you.
You have three mouths to feed, Tyler.
Yeah,
you're doing God's work.
Carson let me work from home today, and in the background, I got basically like 15 kids running around in the backyard here, and they're all like screaming and yelling, like crying. Like I should have went to the office.
I feel like once you get to that stage, it's like the office is a bit of a refuge, so you actually kind of want to go in.
Yeah. I mean, it's great. It's fun to hear it. Be out there in a few.
Childlike whimsy keeps you happy and optimistic about the world for sure.
Exactly. I hope you guys have some kids soon. You can join in the tired fun.
Yeah,
but we can talk about Mike Green inflation for children. I'm eating it right now.
Yeah. Let's just have a little reconciliation of where we've been through the last month. So, man, this December FOMC meeting is turning into a bit of an interesting one. We have been, it's so over to we're so back, and then over, and then back, and then over, and then back. And it's just been quite the whipsaw over the past few weeks on a time where there's been like no real new economic data because of the government shutdown. The only data we've been getting is stuff from September. So just look at this chart, is just crazy to me. So you look at the middle there, and a month ago, we were all but guaranteed a rate cut in December. And then for whatever reason, we started to just get the onslaught of Fed speakers coming out pretty hawkish. And suddenly, before you knew it, we were sub 40% odds for a rate cut in December. And then I forget which day it was, maybe Monday, maybe a little bit end of last week. But then John Williams comes out from the New York Fed and says, all right, I'm actually all aboard a December cut. And so suddenly you saw markets rally, risk on rally. You saw the curve start to price in a cut for December. And now we're right back where we started. And man, it's just crazy to me. Like there's been no new change of data. And we kind of speculated that this was the case. It's just like, all right, well, there's going to be no meeting to November. And we were saying this back in October that maybe they're just trying to buy some optionality. And, there's little risk to them to try to deflate the risk on appetite, the animal spirits a little bit, buy some optionality, and then get back onto it pretty quickly. And seems to be the case. What do you guys think of this whole thing? It's a mess.
I think we laid it out exactly. I mean, we were bullish in October, and then once the Fed came out hawkish, there was still this was like 109 BTC or something. There was still plenty of room and time, and it was before stocks sold off to get bearish ahead of that. And I think we kind of we weren't like that for hugely fundamental reasons, right? Because we all talk about how the market is just liquidity. Like if you plot these odds like in a line chart versus risk assets, it's just the same thing. So, it's not that there was some draconian boogeyman to be like, going crazy about it. And obviously once things started dipping, everyone is looking to assign narratives, whether that be the AI trade over, credit issues, crypto for your cycle stuff. And then they just deflated the air a little bit. And here we are sort of back with not much change. So I think it just validates any criticism of the Fed, because anybody watching the data knew this Beige Book was going to come out bad. Exactly what we said was there's no case in which a government shutdown accelerates the economy. And here we are with things weakening, unemployment rate going up. We're going to get even more data next month that's not going to show great things for the labor market. Like everything pointed to continued deterioration. And here they were pivoting hawkish. So I think this is just par for the course. The thing that I'm curious about is how long are we going to, I'm sort of, I guess my base case until proven otherwise is that we might have another couple months of this chop, wishy-washy back and forth, right? Because getting this rate cut was like, I just mean in this like Fed rate cut stuff, because getting this rate cut was supposedly like pulling teeth of the committee. And Powell, we know, goes through next April's meeting into May, and they don't want to cut that much. And so we might just be in this longer period where it's just this tension of back and forth. Like, are they going to cut again? Are they not? And that's not enough liquidity to send super risky assets to the moon like the summer was, I don't think. So I think we might chop for a while. But stocks have earnings. Earnings are growing. Inflation's nominal. Everything's priced nominally. So, the passive machine kind of ticks on for the large indices. So I don't think there's much to be like super bearish about. But we have rallied back quite aggressively in stocks.
My read on this is and we talked about this last time. It's so centralized that we're basically moving back and forth on Fed expectations. And the really scary part to me was there was some credit stuff unraveling. Like you saw regional banks and the private equity guys, and a lot of those levered places were rolling over when the Fed expectations were easing in December, dropped to like 30%. And that shows to me that we're at the latter points of the credit cycle, but you can really kick it off by easing. And so that's how centralized the central banking is it has this much of an effect when you go from 30% chance of easing in December to an 80% chance of easing in like 6 days. Like what? So you saw industries like NVIDIA had okay earnings and it gets sold because of basically Fed expectations. A lot of these other industries like the quantum computing, high growth stuff got absolutely annihilated, down like 40% for the month. And that's literally all just Fed expectations and heightened, liquidity or financial conditions were tighter.
Yeah, and it's just so funny. Like it's literally a game of sentiment, because in reality, when you really boil it down, like what does the effect of one rate cut do, especially when it's been priced out so many months ahead? Like it's marginal in terms of the true impact of the economy. But then it's just we're in this game of whipsaw based on animal spirits and trying to front run those in one direction or another. And it's like, okay, well now all these random people at the Fed are starting to talk a little angry. So it's like, all right, I gotta respect my stop losses and get out for a minute. And then once they change their mind again, okay, I'm just going to change my mind again and ride the wave. And I think some people will say negatively that a lot of macro these days is just that either, I don't know, trend following or momentum or whatever, but it's because there's only one game in town, and it's the Fed, and you either fight it or you don't. So if you're deciding not to fight it and not going to bear hole yourself, then you just basically have to respect the trend. And especially in a time where there has been no economic data, all we have is just the the vibes-based monetary policy that we've been talking about here. And so you ride the wave. If you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of their products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
It's the Fed, but it's also the market structure. Like, hit me with slide 25. This is the systematic macro positioning from systematic funds from my buddy at Goldman, Cullen. And he kind of shows you have to be nervous when the Fed is hawkish and systematic investors are fully invested, because that means, their drawdown potential, because they basically lever up when the VIX is low. And then when the VIX rises, they basically delever. And so that's essentially what we saw. If you go to slide 23, this is the front month VIX versus the 3 month VIX. This is like the greatest indicator ever. Like, it should be on everyone's, just buy the market when this gets inverted every time, every single time, because we're dealing with quant investors and systematic investors. It works every time because they're programmed to do this. And so when this inverts, meaning you're paying up for downside volatility, meaning, the skew for puts is really steep. That's when you can see that red circle there in the bottom right-hand corner. When it inverts, that means, the ratio is higher than 1, meaning front month is more expensive than 3 months out. That's a sign they've overhedged in the short term. And then if you go back to that last systematic positioning one, so we saw them basically now they're relevering. They delevered in that line down. And now as the VIX drops into the holidays here and everyone's overprotected to the downside, vol drops, they have to relever higher. And then not only that, but if you go to slide 24, this is pension rebalancing into month end. There's a buy of 6 billion US equities for month end. It ranks in the 47th percentile. So you also have this buy pressure from month end into a low liquidity holiday period, which is partly why, November and December are big up months anyway, seasonally, because it's low volatility. Everyone's out of the office. They're not doing much. They're basically hedged out into month end or into year end to try and lock in their gains. So there's a lot of just these dynamics matter way more than they used to. And I don't see people like they talk earnings and it's like the baseline layer when there's a real recession coming. Now, I'm not going to lie. We are in a recession in certain parts of the economy, but then this is what kills me is they literally like all the fiscal policy and the policy from the government is literally just geared toward one sector. And like this Genesis plan where I'm like, okay, I get it's a big deal. I'm glad they know that this is the Manhattan Project of the 21st century. I'm sure AI is like, but like you got to fight as a middle class, like, and lower class person. Like my dad was a teacher and you got to fight for those people. And I don't see anybody in policy because it's just, they don't care that as long as the economic growth is fine and they don't care about everybody else. So I don't know. That's what drives me nuts. It's like, if they were doing like fiscal plans for different other sectors of the economy to basically upgrade them for the AI boom, that's what they should be doing. So it's more balanced growth. Instead, you're going to have this imbalanced growth where, Felix, you can get into this, but like the Fed Beige Book, where they're hiring people because they're so much more productive. Like we're seeing AI work.
Yeah. Yeah. We'll get into that in a sec, but I do want to just double click on what you're saying about what actually drives is market structure these days and how important that is. I've been a big fan, honestly, of this Lord Fed guy that I mentioned recently, but he does some really good work focusing a lot on this. And it's like the big three to focus on. And Tyler, you mentioned this almost every week. It's like you got to be looking at what are buybacks doing, what are CTAs, so trend followers, doing, and then what are these vol targeting funds doing, which is what you just mentioned. So it's like, all right, well, VIX got elevated, so the vol targeting funds need to degrow. So we had that happening. And then you got to track the levels of the CTAs, because as soon as we hit those lower bounds on the SPOOs or whatever, that starts to trigger their sell orders, and that's just purely systematic CTA stuff. And then you have the buyback windows and understanding where those are going. And if you can nail those three, you have a really good idea of where these assets are going. And all three of them, I mean, maybe you can make the argument that the buybacks are related to the economy, but the other two are just pure systematic quant stuff that really has no attachment to the real world. And then you add on the layer of the fact that, to your point about that Genesis project thing, and David Sachs put out a tweet this week where he was mentioning that, okay, well, now half of the amount of US GDP is related to AI CapEx builds. We can't go backwards anymore because we'll be into a pretty significant recession, which is basically an indirect way of him admitting that the only reason we missed a recession is because of the AI CapEx buildup that's been going on. But now they're admitting that we're too deep into it. And so the government's going to have to backstop it. Like, it was funny to see when that first announcement came out from OpenAI talking about it, and they had to backpedal, but it's clear where this is going, and it's going to be that it's going to be the government backstopping it at the very least, and it's the game theory associated with it. You don't even have to have a view on how valid AGI is going to be. The fact of the matter is that when you're against China, you basically have to fully commit as if it's going to happen, because it's suboptimal to try and not do that. So we're basically just cornered into this instance of going guns blazing, and so here we are.
You want to? I'm gonna be real roast these guys for a second, and not. I kind of went at David Sachs a little bit, and he was like, "I didn't say bail the sector out." It's like, but I was like, "You essentially did. Like, you're the guy." And in so many words, and then 2 days later they come out with this Genesis thing. But what's really interesting to me is that there's no contra to they think this is the Manhattan Project. This is the end of the world if we don't win this thing, and they've convinced the entire administration clearly that that's the case. But let's play a little devil's advocate here. A lot of these guys, their politics were absolutely wrong. The experts were so wrong that I'm like, how is no one questioning this? That this is the way we should just centralize our economy. And I take that with a grain of salt, because it's more just I feel like we should be questioning this stuff more in aggregate rather than just letting it slide. And it's driving me a little bit nuts that there's not a bigger pushback on it. It's like, oh yeah, let's just let this big tech dystopia from the tech bros. We need to push back on the tech bros a little bit. Maybe they're right, but at least give me a logical answer.
Yeah, I think we swung a little too far.
It absolutely. I mean, you just look at we talk about all the different factors of this, whether it be, the middle class that is the traditional driver of an economy. But, to your point about the AI specific stuff, going from we'll never bail out to we have to basically backstop. And the thing I would caution is when something gets too big to fail, that's not really where you want to be invested anymore, because you basically become a utility. Like banks kind of, since 2008 have been kind of shitty investments. Many other industries that become sort of like regulated utilities aren't that great. And I think it's the classic, it's kind of like SBF and crypto, where for the longest time, this guy was doing all these things and everyone's like, man, this doesn't feel right. Something's up here. This is the fishiest, everybody's red flag.
He's sitting there with the Clintons on stage, and you're like, oh, he's telling the Clintons what to do. Or if you're like, I mean, what the hell? Come on, let's reel it in here.
Tom Brady.
He's got Tom Brady and Affleck and Matt Damon doing commercials and his whole thing in hindsight, you're nailing it.
But that's what Sam Altman is SBF. That's the best analogy I can think of, because it's such a grand scheme that it's so big, everybody questions it and is like, yeah, I don't trust the guy. There's some funky accounting. There's no way they're going to come up with $200 billion in the next couple of years. None of it makes sense, and everybody knows it. But it's sort of like the crowd theory or whatever, when you're, there's a crime going on, but there's the bystander effect or whatever, where there's a huge crowd. No one actually goes and helps the person, because it's like, oh, someone else is going to do it. Or, oh, someone else is going to call it out. I'm not going to be the one to, stand up and say the ridiculous or push back. And that's kind of where we're at, because everybody knows this is ridiculous, like these AI CapEx numbers. The other thing is,
see, I don't think it was ridiculous. I gotta to push back on that. I don't think it's as ridiculous from like a balance sheet perspective, because you're dealing with the biggest companies in the world that are cash flow machines. Like,
yes, it is, dude.
Like,
their revenue is like nothing compared to the capital they say they're going to raise. This is never the numbers don't.
I agree with that's not. I mean, I agree with that. That's gotten ahead of itself a little bit. But like, I've listened to like the Leopold Ashbrenner, Carl Schulman guys at Situational Awareness, and it could grow into that more so than like FTX was just levering up and convincing. Like, with zero financials, he was just like, "Give me $10 billion," and then he was.
But that's in hindsight that we have all the information, though, too. Yeah. Like we have like all of the information.
The AI thing is real. Like, I think it's real, but it's getting ahead of itself, and it's kind of backstopped by Fed policy, and and I think it worries me.
It's 1,000% real. We all use it every day.
I think that's the point about there's no nuance in it. And I finally had Jordy Visser on the show. I interviewed him. It came out today. It was awesome. Great interview. And he makes the point that he finds it very frustrating about how people instantly look at the lens of AI through this, is it a bubble or not, and comparing it to 1999, because it predisposes itself to very non-useful conversations. It's either it's a bubble or it's not, and the answer is probably that it's somewhere in between, but that's really hard to navigate. And I find it interesting to hear both sides, because to your point, Tyler, we had the Fed Beige Book come out today, and the labor market is not great, as we all expected. But what was more interesting is that a lot of it is being driven by not outright layoffs, but either attrition, or there is some layoffs and then they're replacing with AI. So this is a really interesting point for the Fed Beige Book that I saw came out today. So in there, and this is, again, for those that don't know the Beige Book, each regional Fed president goes out with their team and starts interviewing business owners in their local regional area, and basically gets a pulse on the economy. So this is some of the findings they had from the Beige Book, the recent one. Many contacts noted even modest deployments of AI would enable them to not refill some jobs or to skip a recruiting class of entry-level workers altogether. So you pair that with what you're seeing right now in entry-level job unemployment of like fresh college grads, things are starting to line up. And then you have this other headline that came out this week about HP. They're cutting up to 10% of their workforce as part of an AI push. So they're laying off 46,000 people, and they're saying we're going to be replacing it with AI. We've seen enough traction that we're confident to make this decision and actually commit to it. So yes, I don't think AGI is imminent and all the world's issues are going to be solved. No, I don't think it's an outright bubble either. The answer is probably some sort of spectrum in between. And that's where we just lose all nuance in most commentary, I think.
The other thing is, I want AI to win. Like, I want it to be this massive productivity boom, solve a lot of stuff. I just would love to do it in a way where like the social contract doesn't break. This could be incredible. But like, you're seeing the layoffs, and I don't see anyone yapping about like, how are we going to fix this? Let's fix our education system. How are we going to utilize this? That should be the national conversation rather than, I don't know. Let's just, like, maybe it's charge forward and let the pain happen. And then you figure, people make enough noise but you can devolve into communism real fast. And maybe it doesn't matter if your productivity is like 2,000%, like stuff we've never seen before. But what if it doesn't? What if it doesn't come? What if there is this, like, we saw credit tightening off of the massive bond issuance, and if the Fed kept like hawkish, we could have seen the bonds unravel, and then the bubble could have, like, that could have happened if they were really hawkish. But of course, we get all these, and maybe that's just, we're going to putz along in this, like, you got to trade the sentiment more than anything.
I think how I think about it for next game planning, like investment strategy into the next year, is just trying to boil it as simply as possible, which is, if the elections were today or next month or whatever, or January 1st, would the Republicans win midterms in terms of keeping the House and Senate? The answer is no, in my opinion, based on approval ratings, this recent election turnout, the populist socialist kind of shift across cities, etc. So And then when you look at the map, it's very close. The lead in the House is very close. The Senate, a bit more favorable. There's a lot of Republicans up for grabs, but they're in like stronghold states. So it's an uphill battle for Republicans to keep control. I operate with the belief that during election years, that's all that matters for politician incentives. Like it'd be like, hey, Tyler, your job's on the line. Like, what are you going to do? Are you going to focus on doing a good job for the greater good or keeping your job? It's always keep your job. And so if we put those together, we know that something's going to have to change in their strategy of just stimulate AI at all costs, because there's huge costs that we're seeing appear in Main Street. I mean, the stats this last couple weeks is like the largest emergency 401k withdrawals ever, 30% increase in home foreclosures, like 25% increase in underwater mortgages. Like these things aren't populist, these statistics. And so they're going to have to do something. And I just think that going into next year, there's going to have to be policy change that doesn't just directly benefit. And so I think aside from the bubble, no bubble talk, I think Mag 7 as a whole and hyperscaler and AI trade as a whole is marginally less interesting because of whether or not we're in the 5th inning or the 8th inning. There will be AI related trades. The AI beneficiaries, which thus far AI beneficiaries has been the CapEx beneficiaries, the data centers, the build out, the picks and shovels, everyone likes to say. I think going forward, there's still going to be tremendous winners among AI related theses, but it's going to look a lot different because I think the government's going to have to do something and stimulate different parts of the market to accomplish their one goal of re-election. And that's going to require lifting Main Street out of recession if they want to win.
That's such good framing. Like I think you're right. I think Mag 7 is going to evolve into being utility companies where they are the drivers of infrastructure and AI build out, but the real excitement is going to be what gets built up on top of that. And maybe we need to completely rethink how we're thinking about things, which is let's go look at existing businesses that are stagnant and can they be disrupted through the use of AI, and how do they unlock margin there? One example, just looking at the crypto world and stable coins, is Western Union, right? Is a company that you would intuitively think, okay, stable coins are going to eat their lunch, and the stablecoin rails are going to be the next great thing. Well, what if Western Union, which already has distribution, brand, and tons of connected accounts with people that are doing foreign remittances, what if they adopt stablecoin rails? They already have the brand and the distribution established. Maybe that's how we should. And so what's the version of that in AI, where you're looking at these stagnant businesses that get disrupted, and that's where the margin could be. It's not going to be the ones that are building out the rails. The same as like back in the .com bubble era, all the companies, all the work that was being built on just laying internet cable across the oceans, that wasn't where the excitement was. It was what we built up on top of it. So yeah, I couldn't agree more. It's about how to think about that next, for sure.
And if for all this to work, like if OpenAI to raise their 200 billion at $1 trillion, all these different crazy numbers to work, they all include building like next year's CapEx data center, construction requirement number is like almost is like 2x the number of like 2 or 3 years ago. It's larger than Japan's like energy usage next year. These are unfathomable numbers, and you start to think about, okay, what are the other bottlenecks that like once we start getting into astronomically like incomprehensible numbers, the bottlenecks start to look further down the supply chain and power procurement, other things. And that's where I'm more interested in because stimulation of Main Street demand also is stimulative to commodities and other inputs.
To that point, if you have to finance, say it was like $1.5 trillion on the debt side of things over the next 5 years, not only do you have to, and then you have to finance, it's like 8 trillion of treasuries over the next year or so. That in itself, we have rumors of Hassett being the new Fed governor. I wonder if this is just going to turn into a massive mania to the upside, because you're going to have money multiplier. You're going to have crypto's kind of turning here on asset, I think. And also, I think the midterms are basically starting to they're realizing you can't have crypto just putz along in the next generation. The one thing I want to bring up is like, did you follow that guy Sightseer or Sightbringer or whatever? Where what is crypto? He wrote this, like, he writes these like strings of things and threads, and he basically said, if you think about the economy, the boomers are like the balance sheet. They have all the assets on it, and then the next generation, millennials and Gen Z, are like the income statement. So they just get the earnings, but they don't actually build any assets. Whereas, like, if you sit on, if you're the balance sheet like the boomers, then like you're sitting on assets, and then everyone else is working for you on the income statement. And so it's basically what he was saying was the reason why crypto is so appealing to the younger generation is all the assets are owned by boomers, which is like, stocks, bonds, housing, all the old school low vol assets. So they've cornered them. So if you want the incremental voter now, this is where crypto actually really, really matters, because if Trump and Bessent backtrack on all this stuff on the crypto sphere, it's the way to catch up wealth. That's the way to, because you're not going to do it. You can't do it through housing fast. You can't do it through bonds fast. The only thing that you can catch up on or it's, frontier asset equity, like, quantum computing, Bitcoin mining, AI stuff. So those are the pockets, the long vol assets you have to play in. As long as the credit's fine, now that we know it is, we're heading into like a great credit period here into year end. So you could see some wacky stuff.
If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments and blockchain technology involve risk, terms, and conditions apply. Do your own research. Yeah, I'm still banging the drum about 2026, like everything you just mentioned. And then what's also interesting is contrasting that with where market pricing is. Actually, Quinn, you put in a good chart here just looking at expected cuts for 2026. So way back when, early in the summer, when there was that talk about, we started to hear the talk about who would replace Powell, and that, oh, shoot, we're going to get a Trump stooge in there. He's going to try and control the Fed. The people that trade the Fed funds futures, the Stern markets, got really over their skis about the amount of cuts that were going to be priced in 2026. So they all got carried out. So if maybe you can explain this chart, Quinn, but overall, that's all been reversed. And now we're seeing very little cuts present in 2026. Do you want to explain how you think about this, Quinn?
Yeah, I think that, so right now we're 375 it's basically a guarantee we get the cut in December. And then the rest of it sort of boils down to estimations for 2026 total cuts. And right now, the consensus, I guess, is in the 2 to 3 range. And I think it probably should be in the 3 to 4 range, given how the labor market's slowly deteriorating, what the current trends look like. Hassett to me is I would put my money on him, and I've had this view for a while. Like Warsh is almost too Powell-esque, where he's this guy coming in who's very credentialed, but the risk is a lack of control from Trump's point of view. Like, if I can just totally picture Trump sort of fearing the same outcome with him as Powell, where it was expected he was going to play nice, and then he respected the independents, I guess, more than was expected. And also Warsh was like a massive hawk in previous years, and so maybe loses some credibility when he switches like that. So I just think the policy, we know the policy is coming from Bessent and the White House on banking deregulation, kind of taking control of policy reducing Fed power relative to Treasury, these sorts of things have been in the works and been very obvious, like openly talked about. And so it just makes sense that they're going to put someone in there who they have basically direct kind of collaboration with. And because you, at the end of the day, like, to be fair, not that I don't like any central bankers, and once anybody goes politician, it's hard to be neutral and like really loved. But the mess we are in has arrived because of a continual increase in centralization and working together. Like every crisis, we know Fed, footprint on the market gets bigger, and all this stuff becomes increasingly done in tandem with Treasury. So to like play the other side, to unwind it and to get ourselves out of this, you need a very coordinated approach between Fed and Treasury. Like there's no like cold turkey Fed independence. Like there will be so many ruptures you wouldn't even be able to like drive straight. So to be fair, you need this super linked like unwinding, which I think they're attempting to do. The question is, when you hit turbulence, what happens, and if there's continuous.
If you listen to Stephen Moran, Governor Moran, on his points, his criticism is that we've seen the Fed and the Treasury come together, but nobody wants to admit it yet. And his whole thing is, all right, well, let's just embrace the fact that that's where we're at and formalize it and provide regulatory scrutiny that that's where we are at now, and then try to withdraw the participation of the Fed in these realms they are and move that more onto commercial banks and the private credit creation space. And you can see that that's resonating, and that's similar to how Besson is thinking about things. So therefore, you would assume that is how Trump is thinking about things. And you see, we're recording this just this week. They finally approved the SLR exemption for treasuries. That finally just happened this week. So you can see that they're laying the foundation to basically move the marginal growth of liquidity and credit creation off of the Fed's balance sheet and into the private space. And so people are really, really caught off guard by this because they're used to the last war, which was QE infinity. That's not where we're going. They want to remove the Fed from that, and then to offset it, cut rates a lot. So you keep hearing them talking about wanting to go 50, 50, 50 every meeting. They want to lower the Fed funds range, get the Fed out of what they're doing on the balance sheet and all that nonsense, and then move that money creation to the commercial banks, which is really how things should actually happen. The issue is that post 2008, no commercial banks wanted to lend because they were so terrified of the GFC, and they're impaired by Dodd-Frank and Basel III and all this stuff. So now we're seeing that start to get unwound. We're seeing things like this SLR exemption. I think they're laying the bedrock for where 2026 is going to be. And people are still over indexed on the last war, which is the acronym factory of the Fed balance sheet.
Yeah. It really goes into overdrive when Powell's gone, because he's been slow walking a lot of these bank regulatory changes. So yeah, 2026 is going to be interesting because you're going to play this, like, I think there's still going to be this like teeter-totter back and forth in the beginning of the year of like, are we going to cut or not, this sort of game. And then once he's gone, like, but playing that's weird because how quick does the market front run these changes? Like how soon do they start looking through, and also what assets benefit? Because like if the idea of unrelenting dovishness, no matter what, is the status quo, that's inflationary. Like there's so many cross currents. Like when do they invade Venezuela and when does that oil come online? Probably a couple of years. Like it's gonna be fun, man.
You know what's not gonna sniff a slowdown? Can we go? This. I just got to top this one. This is 26. This TD just put out this report on the gold sector. Q3 was a strong sector. I'm going to read just to piss people off. Q3 was a strong quarter for the sector, with 25 out of 32 companies beating on consensus CPS. Overall production was modestly ahead of expectations. Costs were slightly higher, but this is record free cash flow generation was up 56% quarter over quarter. And then capital returns. Gold miners are buying back stock. Senior producers under our coverage deployed $1.7 billion in buybacks, up 13%. So remember the last cycle when gold peaked? This is like, I was at a fund in Boston that just did gold mining, believe it or not. It's kind of crazy. But they were just trying to dig up as much gold as possible. They were the worst run companies. horribly run. Now they have enough cash flow to buy back stock, which is kind of wild. And then go to slide 27. You can get this is, shout out to TD for this work. It was really good. Quarterly free cash flow. You can get a sense of, where it's, where the growth is. And then if you do the next slide, this is all in selling cost margins for gold miners, which are like tech margins. If you look at that, the green squiggly line, you're looking at, almost 55-60% margins, which is incredible for gold mining. Historically it was just horribly run business, and now no one's dug gold up, so it's rocking. But but this is like a sneaky bull market, isn't it? People, I think the investment is like only 2% or 3% of funds have allocation to gold mining, which is kind of wild.
Yeah. I mean, it's been such a widowmaker trade for so long. Like, I had one of my rules was to never touch gold miners because they're just such a dog for so long. So of course it caught us all off guard. I mean, it makes sense, but obviously we rode the gold trade itself, and that was all well and good. But I mean, these miners are sitting pretty now. I guess the other side of that too, though, is this is my whole thing with investing in commodities is that, okay, this is good right now, but this is because spot price is elevated, which makes their margins great, which means that those potential gold mines that wouldn't have been profitable when gold was at 1,800 or whatever are now profitable. So then you're going to see more miners come online, therefore more supply. And then eventually it's a self-correcting thing. And that's what's always so difficult for me to trade these commodities, is because it looks good right now, but those miners that wouldn't have looked good 5 years ago are coming online right now or are about to be, and then you get more supply, and that's the whole thing. That's commodities trading.
I agree, but to play devil's advocate to that is we've never seen giant company. For 40 years we had petrodollar recycling back into U.S. Treasuries, or export recycling with China back into U.S. Treasuries, or Russia owned our debt. Now there's a global grab for collateral. And I don't know if gold becomes more of that, just along, like Bitcoin might. You have to keep these in mind because they could replace trillions and trillions and trillions of dollars of treasuries and sovereign collateral. So that's where, I'm keeping an open mind that it's not just your regular cycle, because it's the first time, people aren't recycling back into treasuries.
The other thing is, in recent history, haven't had oil prices be such the target of downward manipulation. Like, I don't want to call it manipulation, but like it's the number one priority of policy effectively is oil. Like, that's why they care about peace in the Middle East, peace in Russia, taking over Venezuela. It's all, I mean, Besant mentions it every time he's on TV. Everybody knows it. And they've so far succeeded in getting deals with the Saudis to pump more. Looks like there's progress on Russia, Ukraine, strategic encircling and choking off of Venezuela before whatever happens there. So that's extremely bullish for margins of these miners whose largest inputs are energy to dig the metal out of the ground as well. And that's just a really weird dynamic, because oil just continues to chop lower, and eventually it will, I'm sure, reverse, maybe when they have to lift Main Street out of recession. But for now, their policy mix has worked to bring down oil price.
On that one, two thoughts was like, I think Ben Hunt wrote a piece years ago about like the 4 horsemen of the apocalypse, and like commodity inflation or oil really just breaks the back out of all these like systematic passive things as soon as oil actually goes up. So I think we figured that out. We figured out the software to keep this thing running. But on top of that, there has been probably productivity advances in oil and gas drilling. So like that's one, too. And then the third one is Biden. Like you could make the claim that Biden actually, everyone gave him crap for unleashing the oil reserve, but in hindsight, that looked like kind of a brilliant move, because now you can.
It was a good trade in the end. Hey? Yeah,
it was a good trade. You gotta give it. Who says?
Yeah,
We're bipartisan here. So like to that effect, I think that's a good thing. And
yeah, I'd say a lot of doomers were wrong on that one. It worked out.
Yeah.
Yeah.
But it's so hard to like.
The auto pen should be in the next Market Wizards book.
Yeah.
Interview the pen.
Yeah,
it was a good trade. Fire trade. He was dumping it in the hundreds, and we're buying it back in the 50s.
Yeah.
You know what else is interesting is we're figuring out like diversified streams of energy now. Like Trump's opening up. If you look at the nuclear stocks, they're just like, I mean, I'm talking about the uranium. Like we're clearly diversifying in terms of our, and then not only that, but solar is becoming more and more. I was just reading this Peter Diamandis thing about like solar energy in space where we can actually like harness now, where it'll be there. So energy could just be abundant. And like inflation, if you get this like a world of abundance, that's the real. I wonder where stocks go. Like, where do you price if you don't have to worry about commodity inflation anymore? Where do you price stocks? What's the multiple?
I mean, there was even that whole thing like last year about how scientists were getting close to nuclear fusion, and then it's sort of fallen by the wayside a little bit. But man, like if we unlock that, there's basically limitless energy. Like it's insane.
Yeah. I think that's part of the Genesis stuff. So I don't know. I went on a rant earlier, just railing on a lot of the tech policy. But if it works, I'll eat my words. But these things, I just hope we don't end up like the more you push in one direction, you get the equal and opposite reaction from some people, and the world could get more dangerous in the interim.
Okay, I want to end this conversation with we gotta pay homage to Mike Green, who has joined the camp of social criticism of wealth inequality, of the K-shaped economy, of the boomers versus the Gen Zs. He wrote this piece this week that went pretty viral, talking about where the poverty line actually is. And I won't get too deep into the weeds. Go read it. He made it free, and I'm sure a lot of people watching this right now have already watched the piece or read the piece. It's gone viral. But super simple terms is that the poverty line as calculated initially would look to be about $31,000 a year right now. But when he got into the specifics of the mechanics of how that's quantified, quickly realized that in reality, the numbers are somewhere between $130,000 to $150,000 a year is the poverty line. So again, go into the piece to read the mechanics and how he got there and all of that and his thoughts on it. But I just wanted to bring it to the fore. I think we got to pay some respects to this piece and at least unpack it. And also just, I want to talk to you guys about just the volatile reaction that I've seen from some people. He even said, as soon as I publish this, all the economists are just going to rail on me and just, call me an idiot and all that stuff. And it happened. Like all the baseline institutions were just, they reacted exactly as expected. Oh, Mike doesn't know what he's talking about. Oh, you spent years talking about, managing and trading alpha, and now suddenly you care about this stuff. It all happened. But yeah, I want to get your guys' takes on it. It was a very fascinating read that really lines up with a lot we've been talking about. Yes, you can piece apart the way that he calculated it or whatever obscure economic rule you want to follow. But the fact of the matter is that there's a lot of people that are really struggling to make ends meet right now.
I mean, I think in many respects, the reaction to it says all you need to know. It's sort of like there's times, maybe like 2 or 3 times a year where I put out a tweet that gets this like, where you're surprised at how visceral of a reaction it invokes. And you're like, whoa, this triggered something. It must which is usually like a double or triple. Yeah, true. It's like a double. Before when it was less, it's like a double or triple down sign when it's like, some of the ones were like the MicroStrategy top in November, or when you said one good thing about Besson after Liberation Day. It's like those sorts of things. And so I just think the reaction and yeah, maybe the numbers, like also when people start nitpicking every detail, well, he said this about it's an option writing and selling and it's this number. The general gist is for me is that it strikes a nerve and there's something there. And whether that number is, everybody knows it's not 30, maybe it's not the high end of the 150 range, but like the thing that I also help, like makes sense to me of why Because many people say, oh, well, we can grow out of it. We can lift everybody up together. When the pie grows, everybody grows. And to some extent, that's true, right? The impoverished people have smartphones today. They didn't have smartphones 20 years ago. Those sorts of basic advancements work. But the problem is when, Tyler, that chart you show of profits to capital versus profits to labor are so skewed. When the pie grows, definitionally, those profits continuously compound at a greater rate to the wealthy capital owners. And so that's why you get the burn it down mentality as the solution to fix these things, because growing the pie by definition grows exponentially the wealthy versus the poor. So that's why you need structural policy changes that attack the problem versus like kick the can until you get the pitchforks. But kudos to him for talking about it. Like no one else wants to talk about it.
Yeah, I think it was brilliant. I mean, I'm living it a lot of it. For me, I mean, it's my own fault. I had 3 children, right? But I just have to say, like, I'll give you a little microcosm. My childcare bill for 3 kids in daycare when they were all going to daycare was like $7,000 a month, right? That's way more than my mortgage, and I live in a 5,000 square foot house with a pool. So like, how my childcare bill? So like when I hear like 140, I'm like, yeah, that makes sense. That's it. That's in Texas. So like, if you think about that those types of numbers, that makes a lot of sense to me with children. But if you don't have children, it's actually pretty reasonable. I mean, like, so I think it's different inflation for different cohorts of people. But boomers have it. They're doing great. They basically have zero inflation. Like, what do they pay for? They got all their mortgage paid for. They get cost of living adjustments. Like maybe they go out to dinner and they're like, oh my gosh, it's 15% more than it used to be.
There was an Unreal article and headline in the New York Times. I'm pretty sure it's the Times, like a week or two ago, that was profiling this couple. And the title was like, this family, little did they know when they bought their home in 2020 or 2021 or something, they would be trapped for years because of the cost of financing rising. It was basically saying, like, it was a pity story for them because they have a 2% mortgage or 3% mortgage and they can't move because it doesn't make economic sense. And it was they got roasted beyond belief for like putting this out because they're sitting on a home that doubled in value and interest rates, they're paying like $2,000 a month for something.
2% mortgage is probably the most valuable asset in the world right now. Like,
it was so good. Everyone was like, cry me a river. That's you, Tyler, though. We're going to come after you, man.
Yeah, you
well,
have
I know,
it.
Dude, I have it. And what's so messed up is like, I get it. Like it puts you probably 10 years behind if you didn't get that mortgage at that rate. And so I just don't know. You're just going to get more and more anger. And I think that's where people got to talk about it. Like Mike, I think it's like 500,000 people read his thing. And I don't know how you solve it. You got to and I've been saying this, I want to get a list of things that like millennials and Gen Zs want, which is like tax-free childcare, or tax benefited somehow. You want to break down regulations, break down the monopolies, break apart a lot of these monopolies. That's the number one thing that we have to do because they take advantage of our data. So like we should get paid for that or figure out a way to pay people for their data. Because eventually, capital is now becoming so self-aware that if you have AI, you don't even need a giant CapEx. It's all capital light, right? If AI just starts doing everything, you don't need labor at all. So you have to negotiate these things now. It's kind of like what Hollywood did with the Hollywood writers, where they knew it's coming. Like I can write a screenplay with, with AI right now. That's pretty damn good. Probably, make it sound like a professional screenwriter. And they negotiated all this stuff. You have to do it now, not later. Otherwise you get the communism later. And then you get crazy social stuff. So props to Mike.
Yeah. Well done, Mike. If you're listening and you want to come on the Roundup and talk about it more, the door is open for you.
Yeah, I hit him on Bloomberg and he radio silenced me. I'm
Ooh,
gonna get you
ghosted.
No,
the Bloomberg left on red. That's a tough one.
I will say.
I
know
because Tyler has 100 tweets chirping him. He's like, "Fuck this guy."
Well, yeah, no, I know Mike. Okay, he's a good dude. But you know what's nice is seeing Pomp actually shout out Mike, and I know they went at it over Bitcoin, but like in Mike's theology on Bitcoin, I don't think is actually wrong, but he views it as like you can't run a system on it. But my view of Bitcoin is it's a store of value, just like artwork or gold or whatever. It can function as that. It doesn't have to be based off of like transactions like a dollar would. So anyway,
yeah,
it was good to see Pomp and him agree.
Good stuff. Good stuff. I love it. Good vibes going into the long weekend. Yeah.
Who do you guys thankful for?
Everybody. I'm thankful for you guys that we can chat every week, and somehow this is what we get to do, that we have this privilege. So I'm thankful for that.
Yeah.
Me too.
Good health, good family, good friends.
Health. Yeah.
Basics.
Good,
it's easy to get
laugh.
wrapped up. Yeah. The humor. It's easy to get wrapped up in the technology, but you got to make sure you're stepping back and enjoying the human side of things.
Yeah. On the day-to-day basis, our lives are pretty damn good. And, we got to count blessings.
Keyboard clacking away. Yeah.
Yeah. Felix, we'll celebrate Thanksgiving because you don't have it, right?
No, ours is in October, but I was actually at the Digital Asset Summit for Blockworks during then, so I'm taking this off instead. So I'll be there in spirit for the American Thanksgiving as an employee of an American company.
Sick.
Love it.
Yeah. Cool,
Good
guys.
stuff, man.
Have a good
We're
one.
going to come back looking like gophers next week after all the food.
Later.
All right,
See you guys. Have a good weekend.